Hi, my name is Sunil Fernandez and I'm the managing editor for goodreturns.in. I'm here to do a quick market roundup and tell you what happened in the stock markets today. Today was one of the worst days in the stock markets that we have seen. In fact, the Sensex ended the day staggering 2,919 points lower. We have not seen this kind of fall ever in the history of the Sensex. I mean, in terms of absolute numbers, 2,919 points is unprecedented, and the index closed at 32,778. When we began trade, nobody would have ever thought that the Sensex would have closed almost 3,000 points lower. The Nifty also had one of its biggest ever drops in terms of absolute numbers, dropping 868 points to end the day at 9,590 points. We had stocks being sold across the board. In fact, as many as 1,000 stocks hit 52-week low in trade today. In my 25 years of covering stock markets, I have not seen such a rampage and such sea of red. I mean, it was across the board. 3,000 points on the Sensex is a huge drop. And let's tell you one of the reasons for the drop. The reasons for the drop is simple. The coronavirus. So what's happening is there is a strong belief now that the coronavirus is going to affect global trade, it's going to affect the economy, and the world economy could probably go into recession. Now let's tell you whether this is, the readers are often asking us, is this similar to what happened in 2008 when the markets collapsed because of the Lehman Brothers crisis? Let's tell you two things. Now, first of all, let's make a difference between the present collapse in the stock markets. In fact, the Sensex has now fallen 22% from peak levels seen in January. When it falls more than 20%, it's actually a bear market. So it's now 22%, which means we are now in a bear market. And let's tell you whether it's there to last. First of all, let's tell you the difference between what happened in 2008 and what has happened in the last few days in March 2020. In March 2008, when the subprime mortgage crisis began, it was not really, I mean, you could understand what the crisis was all about, and quantitative easing by the central banks and pumping in money in helped revive economic growth. But in the case of coronavirus, you just cannot estimate what the damage would be. I mean, an entire country like Italy has been locked. There's no activity in that country. It's a rather big economy. It's among the top 10 economies in the world. It's been locked out completely. China, there is no much activity happening. Travel from Europe to US has now been restricted. So really this is going to have a cascading effects, and the markets are really sensing this, and this is why we saw a solid fall in the stock markets today. It's really becoming very difficult to predict how far the coronavirus could impact trade, and the only way the markets could recover is when we have these infections abating. But at the moment, it does not seem that the infections have peaked out. And remember, there is no remedy, there is no cure for the virus at the moment. So really, things not looking too good. And the markets have sensed that and are punishing stocks because the belief is that there will be no growth, and there could probably be global recession. The World Health Organization also late last night pronounced it as a global pandemic. A pandemic is when infections spread across the globe. An epidemic is more restricted to a local area, but a pandemic is when it covers the entire globe, and that's really what's happened. Infections in excess of 120,000 or 120,000 spread across countries and continents, from developed to developing to underdeveloped. So the coronavirus at the moment looks a lot dangerous, and it's not going to worry whether the central banks are going to do easing or the central banks are going to cut interest rates. It's not going to make any difference to the economy, because this time is very different from the Lehman Brothers crisis, when you could really do a quantitative easing and do interest rate cuts, and you could get away. But this time it's not going to be very easy, and probably the economy and the globe will see a prolonged period of slowdown. Now coming to the markets, we had everything falling, so there was nothing that was really gaining. The entire Nifty pack of 50 stocks fell, not a single gainer. To some extent, Asian Paints fell a little lesser than the others, 2.5%, and you can say it was more resilient in a falling market, but otherwise the entire pack collapsed. There was no place to hide. Normally when the markets fall 2-3%, people tend to hide in HDFC Bank, but that stock fell a huge 8%. If HDFC Bank is falling 8%, you can imagine the conditions of the market. Foreign portfolio investors may have resorted to basket selling, so selling at any and every price, which is why the markets fell the way they did. We also saw a host of other markets falling. The German DAX, French CAC, UK's FTSE were all down 6.5%, and the US futures, Dow futures pointed to lower openings. We had the Asian pack fall 4, 5, 6 and 7%, and this is leading to really a scenario where it's become unpredictable and nobody can predict when the stock markets will recover. If you are willing to take a risk, probably it's good to nibble into stocks rather than buying at one go. There is no bottom for the market. As we said, it's highly unpredictable. You cannot predict how far the virus will go, what will happen. So if you are an investor, just stay calm, stay invested, and look to buy on dips little instead of putting money at one go. That's the best solution at the moment. We thank you for watching, and we hope to see you tomorrow as well with a quick market roundup. Thank you.